Good morning, traders, and welcome back. I am your host, Case W. Adams, and we are back with another fantastic episode of the Trader Bacon Show. Now, from time to time, this is a 30-minute show, and from time to time, we get into these conversations, and we just don't quite get through them. Today's guest is has been on the show with us a few months ago, and we got request after request. He finished off the show kind of teasing an experience that he had with his worst trading day ever, which obviously is applicable to being a part of the journey towards the success that he is continuing to see as a paid funded trader with Apex Trader Funding. So we decided to have him back on and see if he could go ahead and finish that story for us and share the lessons associated with it with you guys. So stick around. We've got Jesse back on today's episode of the Trader Bacon Show.
Welcome to the Trader Bacon Show, where we showcase everyday traders that are getting funded, paid, and bringing home the bacon. Are you ready? Because the Trader Bacon Show starts right now.
Jesse.
What's going on, guys? Good morning. Thank you for having me back.
Yes, man. What a pleasure to have you back. I appreciate you hanging out with us and sharing some of this continuation of the story where we left off last time.
Yeah.
I know a lot of people kind of were asking about, hey, so what happened with all of that? And just a quick recap, as we were talking about your trading and strategies and what you've been doing, we kind of landed on the story of what ended up being your worst trading session that you ever, I think it was that you ever had, right? If I'm not mistaken.
Absolutely. That was like the peak of the lowest point.
Well, and that's the thing. This is one of those journeys where, look, it's not this constant. You go get a job and you make a certain amount, and every now and again you get a raise, and you kind of sort of steadily go up. That's not how trading works. It's more like that traditional business model. You're going to have good months, bad months. You're going to go through cycles. Cycles might be seasonal. Cycles might be psychological. I mean, there's so many factors that come into play, but there is no guarantee. There is no necessarily consistency. And that definitely creates a little bit of a challenge for some traders in terms of their mindset. Now, before we jump into this, because I'm so excited to hear about what you had to say and what you had to share with us today, let's take care of a little bit of business, guys. You see on there the form to fill out for the evaluation giveaway. We will be back to normal. We will be giving away announcing those winners at the end of the show. So please take a moment to go ahead and fill those out. We will be giving away 3 evaluations before the show is over this morning. So now that we got that out of the way, Jesse, let's talk about the day.
So yeah, that day, it's funny that it kind of left off like that. It was really rough. It was back when Tesla was trading insane ways, right? Like we were talking about, Tesla was gapping up, 100 points overnight. And I wasn't trading futures back then, but I was, trading options a lot. And man, it was a morning like any other morning. Tesla had made a huge move overnight, and I felt the FOMO. I got into a trade on Tesla, made a couple $100. That was it. I should have been happy with it and cut the day right then and there, or at least diminish my size in any follow-up trade, but I didn't. I was not happy with the P&L because of the way Tesla moved, and
Right.
I saw all those options, how they just increased in value, and I was like, man, I just missed out on $2,000. Mind you, at the time, making $2,000 for me really wasn't like a norm. That
Right.
was a grand slam of days. So I don't know what in my mind made me think that, hey, Jesse, yeah, you're capable of making $2,000 today. So I got back into the trade, and I went from being green on the day to losing it all and being at break even. And then that wasn't satisfactory to me. So I got back in a trade, went red, got back in another one, made it all back, was green. And it was that chop, that insanity. And before I knew it, I was down $500 on the day. Now I'm mad. I was down $800. I'm super mad. I'm down $1,000 on the day. And I'm like, what the hell is happening here? So what I started to do was increase my size on each follow-up trade. We all know what that is. That's revenge trading. And I started revenge trading the crap out of that chart. And before I knew it, I was down, man, I was down like $4,000 in the day. And I stopped and I took like I just went like back on my desk like this, and I looked at the chart. There was no patterns I was trading. There was no setups. I was just opening positions left and right like it was like I was supposed to do that. And
Right.
like, what the hell are you doing, Jesse? And I said to myself, do you make $4,000 in a day for you to be red $4,000 today? I was trading in a $30,000 account above PDT. Thank I don't know if it's thankfully or not, but I never had to deal with PDT. I always had the ability and the money to be above PDT when I was day trading equities. That's one benefit that you have with trading futures and trading with a prop firm. You don't have to deal with that PDT nonsense. So I took a step back that day. It wasn't like I didn't know how to trade, and it wasn't like I didn't have rules. I just threw all that out the window
Right.
because the
So
mental aspect got me.
let me ask you a question here, because I think this is kind of pertinent. Now, how long at this point had you been actively trading?
About, I want to say 3 years.
So about 3 years. So you were not a rookie at this point.
By
In
no
fact,
means.
you had actually been making money as a trader pretty consistently at this point, right?
Yes. I was a profitable trader at the time. But just scraping by, still breaking rules, and doing silly stuff you're not supposed to be doing, right? Like I knew how to trade patterns and setups. I knew how to manage risk. And I had rules in place based off of my statistics, meaning I already knew what my statistics were. Like I had my journal, and I knew what time of day I was more profitable in, what price points of equities I should be trading, all that good stuff. It
Right.
didn't matter when
It
those
didn't matter.
emotions get you.
So well, and last week I actually shared some of my personal story, where I actually was trading mom's money and made an insane amount of money to the tune of almost 600 grand in a matter of a few months, and then wiped all of that out, all of her initial equity, and then after that, in a wonderful set of decision making, all of the equity in her house. So top to bottom, we were talking about almost $1 million. Now, $1 million, 4 grand. There's the similarity I think that we see here is when you started making those decisions, you were up a few $100.
Yep.
And there's this idea of playing with house money. And I think a lot of traders get into this mindset of, hey, man, I'm playing with house money. I will take bigger risk.
Yes.
The problem with that is as soon as house money is gone because you made different decisions, what happens?
You keep the risk on.
There you go.
If
There you
anything, you might multiply the risk because now you want to make back all you lost because you had it there, and you're in your mind, you're like, man, I should have been happy with what I had. Let me try to get it back.
Right.
You know what I mean? It's something that recently over in the Discord we were talking with the guys. Be careful. It wasn't today, but it was like a couple of weeks ago. I was like, guys, be careful. If you already have a couple of green trades today and you have a cushion, don't think you can just go risk that cushion because right now the price action is very choppy. We get into that mindset where we have this cushion.
Right.
Well,
I've heard Daryl say this, I know for sure, and I'm sure this came from somewhere else, and I may have actually read this somewhere, I don't know. But there's just this intrinsic dissatisfaction with trading, whether you're winning or whether you're losing. Now, of course, when you're losing, that's obvious. But the dissatisfaction in the win is what you just described. You were up a few $100. It was a profitable day. You were in the green, but you were dissatisfied because you missed out. Or at least you felt like you missed out on all of this move.
Yep.
Right. So even though you were in the right direction, that dissatisfaction has a tendency to change the vibe.
Absolutely.
Right?
And I can't go back, mentally and remember what the setup was that I traded. I can't remember that. But what I can tell you is that every so often somebody like a new trader in the Discord will type out, or in the comment section on one of my YouTube videos, they'll comment saying, oh, I sold too early, or I covered too early. There's no such thing. Look, we're traders, meaning that we're there to identify opportunities where we can make money and manage risk. Our job is not to capture an entire move.
Right.
If you had like a 50-point move on the NQs in the last 15 minutes, our job isn't to capture that 50 points. Our job is to identify an area where we can trade in and hit our targets, identify an entry. identify where our stop loss area is, very important, and identify our profit target zones, and that's it. If our targets get hit and it goes beyond that, who cares? It's not our problem.
I would much rather, love playing with the house money. I would much rather take 10 5-point wins than one 50-point win, because those 10 5-point wins means that I'm doing something consistently and I'm doing it right. And I think that's one of the big mindset shifts that a lot of traders, once they finally get there, it's like, okay, here we go. Now I think I have a vision of what it is that I should be doing and how to keep myself out of those more challenging days. So you talk about risk and reward and managing that. Share with us a little bit about what you're doing now that helps you manage your risk so that you don't get into a day like that again in the future.
Yeah. So that same day it's amazing, because if you look at my, like, back then I forgot the name of the software. I was using some software to journal my trades, and you could see my equity curve, and you see that day where I just shoop like that, right? And then from there, I went like this, whoop, and I never went back down there.
Right.
Now, for me, managing risk is very simple in the sense that I pick a dollar amount risk that I take per trade. That never changes.
Okay.
I risk the same dollar amount on a per trade basis. The only thing that's going to change is my position sizing to account where my stop loss is, which is where I would stop out and lose on the trade.
Right.
That's it. Now, more important, not more important, but equally as important to me is the fact that I have a rule, multiple rules. One is 3 strikes are out. If you get 3 red trades in the morning, you're done on the morning. I can come back in the afternoon, smaller size, and take a look and see if there's a setup. I'm coming back with a fresher mind. If I start to feel, and this is what I did that day when I saw that $4,000 red on the freaking E-Trade account, is if I start to feel FOMO, if I miss out on too many setups and I start to see those feelings build up, I have to separate myself from this. This is where I have 2 43-inch monitors right here. I have to separate myself from all of this, meaning I leave. I either go outside with my kid and play, I go feed the chickens, I get in the car and go for a drive. If I'm down in our house in the Florida Keys, I go fishing. I stop everything. I jump in my boat that's in the dock in the backyard, and I just leave on the boat, bro. I don't want to be near a monitor. And that separates me. And I have to do that to protect myself.
Sure. Now, of course, you take your phone with you because you can trade on your phone now, right?
I don't trade on my phone. The only thing I'll do on my phone is if I'm in swing trades on equities or options contracts with equities, then I'll utilize my phone to stop out or take profit if I'm out on the road or something. That's it. But I know you can trade futures on your phone, guys. I do not trade futures on my phone.
That's the key. Know what rules you have and stick to those rules, right?
Yep.
If you trade on your phone, great. There's nothing wrong with that.
Nope.
But if you're not used to trading on your phone, don't decide to do it in the middle of either a really, really good day or a really, really bad day, trying to either capture more of that move or make up for it. Because
I know, for me, I know that I cannot properly trade, and I cannot properly analyze charts on my phone. So I stay away from it. The only time I use the phone is for swing trades or watching my long-term portfolio. That's it. I know that I cannot trade futures on my phone. So I don't have anything on my phone to trade futures in, because I'm just going to get myself in trouble.
Right.
I know people who solely trade on their phone and they make bank.
Yeah. Yeah. But they're conditioned to doing so.
Exactly.
And I think that's the big difference, is when you start changing around your patterns, not necessarily your chart patterns, but your patterns of behavior, that's when a lot of times people get into problem areas.
100%.
So we love the visuals. Why don't you share with us some of the charts where you I think you said you had some screenshots where we can take a look at some examples of what we're talking about here.
So I have a screenshot here I'm going to share with you guys. But man, what I want you to understand here, you guys are seeing Tesla behind me here on the chart. And you're like, oh, that's not futures. That's not the ES or the NQs. You're right. But it doesn't matter, because when you learn to trade patterns and setups, they work across the board, from equities to futures contracts to crypto. It doesn't matter. One thing that I do is I trade when I'm trading futures, I like to watch the SPY. Like if I'm trading the ES or the NQs, I like to watch the SPY. And one thing that I see often is people will talk about, oh, the market makers got me. Look, more often than not, the market makers didn't get you. You just placed your stop loss in the wrong area. And I saw this the other day on a YouTube video. Some educator was talking about a setup, and I made a whole video on the topic. He was talking about a setup and where to set your stop loss, and the stop loss was just in a horrible place. In fact, he was using like the replay, and the replay stopped him out, and it continued going in the right direction because this. And it's not to say that if you set your stop loss in the right area, you're never going to get stopped out. No, the purpose is that if it gets there, you get stopped out.
Sure.
But you're going to get stopped out in the right area. For example, here on the SPY, this is a bear flag. I know it's a gap down, but it's a bear flag. Just picture another candle here, and you have your flagpole. There's two ways, in my opinion, of trading a bear flag. Might be three ways, but you'll see people that won't see the bear flag or won't understand where the resistance zone is. And they'll go ahead and, let's say down here where we're kind of getting at the bottom end of the bear flag, they'll grab a short or they'll get short ES contracts or NQ contracts.
Right.
And then you get a little pop and you get right. This purple line is the VWAP. You get a little pop over VWAP and they stop out. And like, oh, damn it. The market makers got me. No, the market makers didn't get you. You just placed your stop zone in the wrong place. Because you have a bear flag. If you're getting short inside of this flag, your stop is if we change the direction, and it invalidates the pattern, meaning we break up and over the flag, this bear flag. We break out of it to the upside, then you stop out. That's your proper stop loss. If you would have traded it that way, you would have never gotten stopped out, and you look at the downside on that
move. Right. So basically what you're saying is this guy actually had his stop inside of the flag?
No, this guy was long on I think it was NQ contracts. He was long, but his stop zone, instead of being underneath support, it was inside of the support zone. You can't set, like, you identified the support correctly. You cannot set if you're long, you cannot set your stop loss at the support zone. You got to set it underneath. For example, here you have, this is an equity again, but like I'm telling you, the reason why I like to use equities to practice and identify chart patterns is because generally your chart can be a little bit cleaner. Here, clear as day that this is your support zone right in here. Look at these arrows that I drew.
Right.
If this is your support zone, and you can get long anywhere, but you cannot set your stop loss there. You have to set your stop loss underneath it. Right. So if this support zone is $5.60, you cannot set your stop loss at $5.65. Right. You got to set your stop loss, and you always want to allow some wiggle room under $5.50. That's where your stop loss goes. Boom, to the upside. Look at Tesla today, for example. Can you see the daily chart? Yeah. I'm currently in a swing trade to the short side on Tesla. Okay, so full disclosure. Right here, you have previous resistance zone. We got up into this vicinity, tested it today. We're rejecting away from it.
Right.
My stop loss on this swing trade is if Tesla gets back up over this zone. Anything else Tesla does inside of here is irrelevant. It doesn't matter. It's just noise. Right. It's like a commercial. What do we do with the commercials on like Hulu or something? We try to skip them, right? Or on Netflix, you mute them, you skip them. This is just anything Tesla does in here, anything the NQ, the ES does within the trading range is noise. The point is, if you get to the stop zone, which will be in this case above the resistance area, then I stop out of Tesla.
Right.
And that's the same way I trade the NQs. That's the same way I trade anything. Let me see. Here is an NQ chart. This was me on a long setup. Look. Right here, we bounce off. And remind you, I don't take these setups just solely based off of the 3-minute chart. I identify these support and resistance levels on bigger time frames like the hourly and daily chart. Okay. So here, we don't even have a price level here, which is great. I love it. We're just looking at the chart and the price action. We bounced off this level very nicely. We came back up into it. I got long. Guys, my stop loss is underneath this level.
Right.
We came back underneath here, and I'm not going to stop out, right? Why would I stop out? It doesn't matter. The stop zone is here. And take profits up here and the little bounce. Next take profit would have been up here. It didn't work out completely, but I still managed to take a nice trade. That's the trade of 8. That's trade of 8 trading with Apex. I'm a funded trader trading with Apex, and I use Tradeovate.
Right. So yeah, Steve asked this great question. Do you look at other top tech stocks while trading the NQ?
I love that question because yes, not necessarily all the time. I'm primarily looking at SPY and I'm primarily looking at the Qs, but I do look at Apple. Every once in a while, I'll take a glance at Apple. I'll take a glance at Nvidia. I'll take a glance at Tesla. I'll take a glance at some of these names. Tesla's relatively weak lately, and that's why I'm short it right now. But yeah, I'll take a look at Apple and I'll take a look at the NQ. I'm sorry, I'll take a look at Nvidia. These guys that are leading the pack right now, especially Nvidia, and I'll see what they're doing for sure.
Awesome. Now, when it comes to risk versus reward, do you look for a minimum ratio or is it always the same? How do you structure that?
So I'm trying to see if I have a screenshot here because I was kind of ready for that kind of question today.
Well, this is my favorite question. This comes from a scalper who was seeking 9 ticks on a 21 tick stop loss. So this is a huge question for me. I realize that that's probably not the best way for my temperament. It works great for a lot of people because it's a very accurate strategy. However, that just turns my stomach. So I know what works for me and what doesn't.
Yeah. So that going back to that example I was talking about earlier, where the guy was putting his stop zone in the trivial area. You cannot put stop zones in trivial areas. The chart that you're looking at and the other charts with larger time frames are going to tell you where your stop zones are, whether you're short or long. He was using a 1-to-1 risk to reward. If you use a 1-to-1, I'm not going to tell you, oh my God, that's terrible, that's wrong. It's just going to put a humongous amount of pressure on you. You're going to have to be right well over 50% of the time. Whereas I've had months where I've been an accuracy of under 50% and still made money.
Right.
But I try to do 1-to-2s on my first take profit. There will be cases where I will take a 1-to-1. I always scale out of my positions. The only time I stop out of an entire position is if I'm getting stopped out because I'm wrong, or maybe I'm in an evaluation and I took the entire trade in one fell swoop, especially keeping in mind the trailing drawdown. But if I'm trading in my regular account, or if I'm trading in an account that's already surpassed the trail and it's funded and surpassed the trail, right? So I have plenty of wiggle room. I always scale out of my positions.
Sure.
I don't hold on to the entire position. So there could be cases where I take a 1-to-1, but more often than not, on my first take, I try to make it a 1-to-2. And then ultimately I try to get my last pieces off for 1-to-3s, right? But look, right here, this is January 1st till today, the 12th, in one of my funded accounts. I lost today $140 something, really small red day, but it's up almost $9,000. It was up $9,000, but I lost 140 today. So I'm up 8,800 on this account with a 55% accuracy. Look at my largest losing trade, $960. My largest winner, 2,000. You know what I'm saying? There you go, 1-to-2.
There you go.
Now I'm trying to fix my average here a little bit because it's a little bit too high, meaning I'm not necessarily trying to lose less. My losers are fine, but my average winning trade is a little bit too small. I need to up that a little bit more. I need to get that closer to $300 for me to be more comfortable and feel more appropriately, in my trade plans. This is one account, right?
Right.
And then
I'm super big into statistics, and I think that's a really valuable point that you just made right there. If you are on top of your stats, if you are on top of what your numbers actually look like, and I know that you can just flip a switch and see this in one fell swoop. Like this is like my favorite trading page that I have, right? But when you can identify those pieces of the puzzle that are like, okay, if I make a small tweak here, that has a huge net effect on my overall profits. And the only way you can do that is by being aware. So anyway, I'll let
exactly. Going back to the 1-to-1 risk reward, in order for you to make money and a 1-to-1, you're going to have to be right at least 60 to 70% of the time, and 70% accuracy over long stretches. I mean, you could have a month where you're 80% accurate, maybe even 90. It could happen in a month, but over a long stretch, 70% accuracy is professional trader. This is like hedge fund traders. Okay.
Right.
And look, with having a little bit better risk reward, 58% accuracy. This is another account from January 1st till today. It's up $5,500, 58% accuracy. Largest losing 925, largest winner 1,200. I don't like that. They're way too close. my average winning trade to average losing trade is a little bit better, 226 to 310, right? So I kind of like these stats are a little bit better in one sense. Overall, I'd have to mix both accounts and see where the stats really lie.
Sure.
My longest losing trade 3 minutes, my longest winning trade for almost 5 minutes. So I like that. That's pretty good. I'm a bit of a scalper, but I try to grab bigger moves. I don't worry about, I got 3 ticks, 5 ticks, 10 ticks. I trade for points.
Sure.
So I'll risk 5 points, looking for 10 on the first take, 15, 20, and up to 30 points on my final takes. Just last week, I want to say Friday, one of my best trades, I think, was somewhere around 27 points in my last take. So I had 3 lots or 3 contracts. My last one I took for, I think it was 27 points.
Nice little run.
And I don't know if I have the screenshot of that one. Let me see. No. Well, maybe, but I can't find it very easily. I know we're running out of time too.
Yeah. So now if you're looking for that, let me ask you really and truly, what is the lesson? So we started off talking about your big red day, right? So for you, we talked about, adjustments to risk and reward. We talked about the obvious question of sticking to your rules and your strategy. What's the big lesson that has just turned around your trading since that particular event?
It's having the max loss set up, in your mind. It depends on the trader. Some people really need to have this done manually in their software, where if they hit a max loss on the day, the software cuts them out and they don't trade anymore.
Right.
For me, it's all mental. I rarely ever have a physical stop. I use a mental stop because I know that I can stop out of the positions. Why? Because I learned the pain. So I don't like it. So I'll stop out of the position. If I'm wrong, I'm wrong. It doesn't matter. You see, once you finally find profitability, you get to the mental point where you have a red day and you're like, okay, who cares? I know I'm going to make it back. I know I have the skills to make back red days. But typically my max loss on a day in the funded accounts is about $1,000. I don't mind that because I know on a banger day, I'm going to make $2,000-3,000.
Sure.
Right. So that's where I keep my max loss. But you have to find profitability and you have to get educated. Trading is one of the only careers that I've ever seen that you could just jump into without any formal training, and you'll try to make money and then you'll lose money. You'll be like, oh man, why do I keep losing money? Well, it's because you didn't train yourself up properly.
Right.
You don't go out and become a lawyer or a doctor or anything like that without training. Dude, you're a trader. You got to get trained up. You can't just jump in there with the best. You're jumping in with firms. You're jumping in with banks. You're jumping in with retail traders that are trained up. And you're not trained up, you're going to lose. I'm sorry to say it,
And add to that, particularly in the case of the retail trader, we are talking about a highly emotional topic, which is money. As much as anybody wants to dispute that fact, money is emotional for most people.
Oh, yeah.
And whether it be a win, whether it be a loss, there is that emotional impact. And at the end of the day, you have just got to manage that expectation and how you handle those emotional ups and downs. So, dude, this has been fantastic. I appreciate you coming back on the show with me and sharing some additional wisdom. You've got such a dynamic personality. I know people love to watch you over there on YouTube at Trade with Jesse W. So if you want more of Jesse, I know I do, getting some of that extra content, go check him out on YouTube. Fantastic stuff. And we have some winners today. Peter P., Soren, and Worley. Congratulations. You guys have new evaluations from Apex. You will be getting an email before the end of the week with all of the instructions on how to get those set up. Come on back next week. We're going to have another great guest for you and some more great insight. Can't wait to see you guys next week on the Trader Bacon Show.
Have a good.
Welcome to the Trader Bacon Show, where we show